typically these cost segregation studies, they're done one of two ways. Typically, the first way is you would have an engineer who is well versed in this area. They would come down and they would survey your property. Think about it almost like an inspection, right? They're coming down, they're surveying the property, they're taking inventory of every component, and they're going to go back to their office and they're going to give you a report. That report's going to say, okay, well, your property has, it's going to give you like an itemized report. Okay, this amount of property is going to be 27.5 year property. This amount's going to be 15 year. This amount's going to be 5 year. And that 5 and 15 years was eligible for bonus depreciation.
You have found Authentic Business Adventures, the business program that brings you the struggle stories and triumphant successes of business owners across the land. Downloadable audio episodes can be found on the podcast link found at drawincustomers.com. We are locally underwritten by the Bank of Sun Prairie, Calls on Call Extraordinary Answering Service, as well as the Bold Business Book. And today we're welcoming / preparing to learn from Thomas Castelli of Hall CPA. We're talking real estate and we're talking taxes, which I guess in the end, if you're making money with real estate, taxes go right there. So Thomas, how are you doing today?
Not too bad. How's everything going with you? I mean, today's a beautiful day in New York, so I can't complain.
Yeah, we're at a beautiful day in Wisconsin as well. So I guess the meter's running everywhere. So yeah. Let's get down to it here. You are in both the real estate investment world as well as the CPA side. So how does that happen?
Yeah, so this journey started for me back in college. So during my teen years, my parents always kind of herded me towards the college path. I always wanted to be a full-time entrepreneur, but teachers, guidance counselors, parents, friends kind of made me feel like I was crazy for wanting that. So I went to college, and I went to college for accounting because of business and accounting, because that's what I was told to do. So I did it. And through like my sophomore year of college, what I realized was that in order to like live the lifestyle that I wanted to live, or what I envisioned for myself, that probably just doing accounting wasn't going to get me there. So I started reading books. I started with The Richest Man in Babylon, like the personal finance book, and then it went into Rich Dad Poor Dad. And from there, the rabbit hole went pretty deep, and I fell across real estate. And it was a common theme in a lot of these books. So I started, then what ended up happening around the time I was graduating, my great uncle had passed away, and he was 99, lived a great life, and he had this small house on this relatively large plot of land that he never did anything with. And it was right down the block from the Long Island Railroad, which went right into Penn Station in New York City. So I knew that it was like people were always trying to buy houses around there for that location. So I knew there was something to be done with it. So I went to a Long Island RIA, which is like a real estate investment association, trying to get someone to help me like develop or wholesale the property. But the executor of the estate, between that and my own lack of experience, that never transpired. However, two things came out of that meeting. The first thing came from that experience was at that RIA event, I met a group that did real estate syndication. So they bought these big properties, raised money, renovated them. So I went to one of their 3-day weekends in between the summer where I was starting my full-time job in accounting. And I fell in love with the model of syndication, started going down that rabbit hole, started attending their monthly meetings and everything like that. And eventually someone who would become my mentor within that group brought me a deal that they were doing in Ohio, pitched me the deal. And I said, you know what, let me take it to my parents, show it to my parents. They invested some money. I invested some money. It was at the time not that much money because I was just kind of coming out of college, but it got my foot in the door. He kind of showed me behind the scenes, and we eventually syndicated an 82-unit apartment complex together, me, him, and a few other partners. So that was exciting. I was on the active side of that deal. And also, just kind of quick tidbit, that house, my uncle's house, whoever bought it ended up knocking down the house and putting up 3 houses. So at least I was on to something. I just couldn't execute on it at the time. So that's kind of how I got into real estate investing. And then then I was working at a large accounting firm, and I realized, okay, corporate isn't for me. I want to be more moving. I have more mobility. So I said, how can I marry this passion for real estate with my background for accounting? That's where I met Brandon Hall here at Hall CPA. And I came in when the firm was very small, and kind of worked my way up through the growth of the firm. And here I am today. I'm a partner at the firm. So that's kind of how I got involved and kind of got in this world.
Nice. That's awesome. Sorry to hear about your uncle.
Yeah.
99's a good run. So good for him.
Yeah. He lived a good life. He lived a good life.
Tell me, I guess I have to apologize because I'm not terribly familiar with real estate syndication. For the listeners as well, what is real estate syndication?
Yeah. So real estate syndication typically involves buying large properties, like large multifamily or commercial properties that one person couldn't. Well, individuals certainly do take down these buildings or do buy them, but it's more challenging. So what happens is you'll have a sponsor or a general partner. They might have real estate experience. They know how to look at how to value properties. Identify opportunity. They know how to put renovations in place and everything like that. Run the deal, and then they go raise money from passive investors or limited partners. They're called, who are pretty much just putting up the money for it and really don't do much else, which is fantastic for on the limited partnership side. So that's kind of what real estate syndication is. Sponsors are buying large properties in order to finance those properties. They're getting financing from the bank, but they also need the money for the down payment and the renovations, and oftentimes that comes from investor capital. So that is kind of what a real estate syndication is in a nutshell.
Got it. So, in the case of an investor, what typically are they expecting as a return from being a part of that syndication?
Oh yeah, it certainly varies depending on the investment opportunity. In the type of investments that I'm familiar with and that I invest in, we call it value add. So value add is where you'll buy a property, perhaps it's distressed, or maybe it's not distressed, but there's additional value that you can add to it to either get the rents that are currently at the time of acquisition below market, or if they're not below market, you can maybe sometimes push them above market through renovations. And basically, there's a substantial amount of value that's created because the way that commercial real estate is valued, it's valued based on a number called NOI, net operating income. So the higher the net operating income, so the more you can drive up the revenue or the rents, and the more you can minimize those expenses, the higher the value of the property is. So within the strategy, you'd go in usually somewhere between a 3 to 7 year hold period. It kind of just varies based on the project, and investors can expect anywhere from, if everything goes right, anywhere from 15 to 30%. Now, I will say this returns that over the last 10 over pre-pandemic and kind of over this run up we saw, over the last maybe 10 or 15 years, those returns were easy to get. Now, in today's environment, you're probably looking more at like 15 to 20% ish. I just got an email today that a group wrapped up their fund, which is just basically a syndicate where they're buying multiple properties, and they wrapped up their fund after running it for 10 years, and they got a net 19.9% internal rate of return to their investors. So it definitely varies, but if you're investing in these things, you definitely probably want to be looking north of 15%.
Gotcha. And you're talking annual, right? Or is that total?
Yeah, annual internal rate of return. Yep, annual.
Gotcha. Okay. Just so we're making sure.
Yeah,
So, I mean, that's still 19%. That's still nothing to sneeze at. That's healthy.
yeah. Yeah, no, it's definitely the reason why I got involved in it is because of, it's in my view, the stock market's harder. You can, they call it alpha in the stock market, which is beating the index. It's challenging to beat the index as an individual retail investor. I'm sure people do it, but it's certainly statistically speaking less probable. However, in the private markets and private real estate, because the markets aren't so efficient, you can't just buy stuff with the click of the mouse typically, and there's a lot more room for operational error, if you will. There's more opportunity in that space. So when I found out about that and found out about the potential returns through my own experience as well as the experience of others, that's kind of what attracted me to that world, because certainly a 15 to 20% return is much better than your 10% on average roughly return you get from the S&P 500.
Yeah, absolutely. Now, tell me, when you're a member, an investor of one of these, I am hoping, I don't know for sure, but are you just fronting the cash and then just wait for the check to come in the mail a few years later? Or are you having to do something else besides that?
Yeah, no. So in a long story short, yes, what you just said is how it works. However, what I would say is that this is the private real estate markets when you're investing in syndicates and funds. Once you give the money to the sponsor, you're relying on them to run the deal. So from my experiences, what you want to do if someone's considering this, the most important part of this is vetting the sponsor, right? Because they're once you give them the money, you're relying on them to produce the return, give you your money back. There's certainly instances where sponsors have not done the right thing, whether just due to error or sometimes malicious intent or something like that, where they stole the money. So you want to make sure that the sponsor has a track record of success in the market. So, for example, if they're syndicating multifamily properties, you want to in South Florida, I'm just making this up. You want to see you want to see, or Jacksonville, Florida would be a more accurate representation. Uh, you want to make sure that they have a track record of successfully doing these multifamily deals, probably over an extended period of time, like maybe perhaps 10 years. I'm not saying you could go, not saying it's a hard and fast rule, but the more experience they have demonstrating that they have the ability to do this, the better. So that's kind of the most important thing, is vetting the sponsor, making sure they have a record of success in the markets and the asset classes that you're investing in. Because once you hand that money over, you're not doing much. There's going to be usually quarterly updates. They'll do like a quarterly webinar, send you a quarterly update on via email. But beyond that, there's not much you really have to do at that point.
And can you tell me a little bit about the timeline? Because I imagine you buy a property and they're fixing it up and the market's going to change. So I
Yeah.
imagine that timeline may be somewhat fluid,
Yeah.
depending upon where the market's at and where the people are at with the, I guess, whether that's the investors or the person. You had a name for it, but I can't remember it.
The
The,
sponsor.
the sponsor, the person that's, I guess, making the deal happen. Are they
Yeah.
saying, hey, let's hold on to it for a year because the market's kind of cooling down? Or,
Yeah.
hey, we're thinking about holding on to it for 5 years, but the market is cooling down. So let's get rid of it now.
Yeah.
How does
So
that timeline work?
yeah, so the timeline's certainly a little fluid, usually in the legal documents, and usually the expectations they set with investors and within the legal documents themselves. They'll give themselves a room to wiggle room. So you might see an opportunity that's going to run 5 to 7 years. And because it may be in year five when they might project to sell it in year five, but in year five it comes around and the macro economy, interest rates are up, or whatever the case is, the market's down and it's not the most favorable time to sell. They might say, we're going to hold on to it for another year, and we're going to sell in another year. And I've seen that happen before where things have been extended. I've also seen timelines that have been collapsed. There's also, like, for example, the 18-unit apartment community that I mentioned. We were supposed to do that in 3 to 5 years. We ended up doing it in less than 3 years, and that was because we achieved. That was partially because we achieved our renovation, I guess ahead of schedule, and our rent upgrades, but also the market at the time was so robust that the properties appreciated so much in such a short period of time. We hit our goal prior to that 3 year mark. So we went ahead and sold around around 2 to 3 years instead of at that 3 year mark.
Nice. So,
Yeah.
from a tax point of view, if I'm an investor, is that considered capital gains, or what is that, or is that just true income, or how do they treat that?
Yeah, that's a great question. So when the property is sold, it's usually going to be considered a capital gain. Now within that capital gain, there's something called depreciation recapture. So when you buy the property, so yeah, when you buy a property, it's there's a non-cash expense called depreciation. It's one of the biggest tax benefits of investing in rental real estate, and that's true whether you buy a rental property directly or whether you do it through a syndicate or fund. And what that depreciation does, because it's non-cash, it helps you shield your rental income from tax during the period of ownership. And in some cases, you can have multiple investments that are throwing off these losses due to this non-cash expense. And that can actually help you shelter your capital gain from these real estate investments when it comes time to sell. So in other words, to give an example, what depreciation does, if you look at a profit and loss statement, say you have rental income, you're going to have all your expenses. These are typically going to be hard expenses like paying the property manager, paying the vendors. This is money that's leaving your bank account. However, then there's going to be this big expense. It's usually pretty large in the first year, depreciation, which it only shows up on paper. So you might tell the IRS, hey, I lost money on this deal, but you might be pocketing cash flow. You might be actually putting money in your pocket. And what happens with this loss in many cases like for these investors is it will just carry forward to future years. And it's not uncommon to see in the year that the property is sold that the investor has a bunch of these losses, whether it be from that specific property, perhaps from another property they invested in as well, that are available to help offset the capital gain. So one of the unique things, and I don't want to go down a rabbit hole, but one of the unique things about real estate compared to other investments like stocks that in a taxable account, if you will, or not in a retirement account, is that you can shelter. It's easy to shelter and kind of defer taxes on real estate, where it's more difficult to do that on other assets.
Nice. So tell me, I'm just learning about depreciation, and I feel like I learned about it late, just based on the tax bills that I've had. So with this depreciation, the way that I understand it, which I'm certain is not correct or not the full story. Not a CPA.
Mhm.
The idea is with depreciation, you take depreciation, but then when you sell, you have to recoup that depreciation or something like that. Can you help me understand
Yeah.
that?
Yeah. So this is probably the best way to describe it. Let's just say that we have, and I'm just going to use simple numbers here. So if there's any accountants listening, I'm not doing this complex math right now. I'm just going to give just to illustrate the point. Say you buy $1 million property, right? Say you hold it for, let's just call it 10 years. You might have $200,000 of depreciation. So what they call it that when you initially purchase the property, that's called your cost basis. So you have $1 million up here, right? Now you took $200,000 of depreciation. That depreciation reduces your cost basis and gives you your adjusted cost basis. So in this instance, you had $1 million property, $200,000 of depreciation. Now you have now your adjusted basis is 800,000, right? Now say you go sell that property, keep it simple, 1.2 million, right? Hopefully sell it for more than that, but it's 1.2. You have now you have a $200,000 capital gain. That's from 1.2 to 1 minus 1 million, right? But now you have an additional $200,000. It's considered a gain, but it's called depreciation recapture, meaning you have to pay tax, a certain amount of tax on that $200,000 of depreciation that you had originally taken. However, I will say this before I move on from before I end this, but is is the reason why you do want to take it, even though you have to pay taxes on it, is because if you can take the depreciation, when you first acquire the property and use it to reduce your tax bills, a dollar today is worth more than a dollar tomorrow, thanks to the time value of money. So you can take that dollar and go reinvest it, um, you know, into another investment, and that investment could be earning a return while you own this property. And then eventually, when you pay it back, or when eventually you sell the property, there's actually ways to defer that depreciation recapture or minimize your exposure to it rather. So there are strategies to get around it.
Gotcha. So help me understand just to dig in this a little bit deeper with the simple math here. The $1 million property, dropping that to 800,000 with the $200,000 of depreciation. Is that because that $1 million property was held for 5 years and you're taking, I'm thinking what commercial properties like 39 years or 39 and a half or something like that, or I forget
Yeah,
exactly the term. Residential is different.
yeah. So if we're residential and that and multifamily is included in residential, the property is depreciated over 27 and a half years. Where commercial properties like retail, industrial, offices, things like that, that's 39 years. So it's depreciated over 39 years. However, since the Tax Cuts and Jobs Act of 2017, there's been something called bonus depreciation that has been available. And what bonus depreciation allows you to do is significantly accelerate that depreciation expense in the first year. So it's not uncommon to see people. In the past, it used to be at 100% bonus depreciation. So it wasn't uncommon to see people depreciating significant amounts of their property in the first year, and having an outsized depreciation expense, which is maybe perhaps why you'd see a large number like 200,000, even if you only held it for 5 or 10 years.
So is that number, the 200,000 in this example, when you're talking bonus depreciation, are you just grabbing that number out of anywhere? Because up to
Yeah.
100%, am I understanding that to
Yeah.
be
So,
a
so, so I
million
didn't.
dollars?
Yeah. So let me give a more realistic example. I just pulled those numbers out just to kind of illustrate the
Sure.
concept. If you had $1 million property, so first thing is the land is never depreciated. Only the improvements on the building itself, and some of the land improvements that are appreciated. So you might have $1 million property. Now, within that property, that would be typically depreciated. Let's say it's multifamily over 27 and a half years. So if you depreciate that over 27 and a half years, so let me take a step back. So this $1 million property, we're going to take out the land value. So the land,
Okay.
we're going to say that the building is worth 80% of that $1 million, and the land's worth 200 grand. So that means you're going to be depreciating $800,000. If you did it over 27 and a half years, you'd be roughly looking at a $29,000 depreciation write-off each year. However, bonus depreciation, so if you do a cost segregation study, what a cost segregation study does is it breaks down the components of the building into their useful lives, because you don't just have the roof and the structural components. You might have appliances, carpeting, fixtures, decks, things like that. So, and all of that's eligible for bonus depreciation. So say you do a cost seg study, you might you might be able to bonus depreciate, let's just say 25% of that $800,000. So that's $200,000. Now, this year, now it used to be at 100%. So it used to be you'd be able to deduct that entire $200,000 in the first year and get this outsized depreciation expense. Today in 2024, it's 60%. So you would
60.
yeah, they reduced it. It's phasing out 20% per year. Next year in 2025, barring any tax legislation changes, it's going to be at 40%. But this year it's at 60%. So you're looking at $120,000 of depreciation in the first year.
Gotcha. And then the subsequent years, how does that work?
So the subsequent years, you would still continue to depreciate the property over 27.5 years. So
Gotcha. Okay, so it'd just be normal. So you take a
yeah,
big boost in year one, and
right.
then it's little by little the subsequent years. So then when you sell that property, tell me about that then,
Yeah. So when
as
you
far as that
sell,
depreciation goes.
yeah. So let's just say, again, if there's any accountants out here, I'm not breaking out the real calculator for that, like the real depreciation calculator.
Sure, just ballpark.
But so let's just say you depreciated. Let's just say so you took 120,000 in the first year. Now you'd be left with this $800,000 property, and you took 120, so now you have 680 left. So let's say that over 27 and a half years, you're gonna have an additional 24,000, roughly 25,000. And then you're gonna say we multiply that by 5 years. The 5 years you held the property, you're looking at 123,000 plus the original 123,000, the 120,000 you took in the first year. You're now looking at um you're now looking at roughly like $145,000 of depreciation.
All
Um,
right.
no, excuse me. I'm like doing this math on the fly right now.
No, you're good. You're good. I'm putting
It's
you on the spot here, so sorry.
it's you're looking at maybe 240,000. So let's just say you sell the property for 1.2 million, right? Um, Now when you sell the property for 1.2 million, your cost basis in this original $1 million property is going to be 760,000. So then now you're selling it for 1.2. So now you have a total gain, they're going to call it of 440,000. However, $200,000 of that gain is going to be considered capital gains from appreciation. And that's usually going to be taxed at rates up to 20%. And then this additional amount, depending on the type of recapture, it could be taxed at your ordinary rates up to 37% for the personal property or the 5-year property, as well as any other property that was bonus depreciation or accelerated depreciation was used on. And then the actual depreciation from the physical structure itself, the actual building, that's going to be taxed at a rate of up to 25%.
Wow. Okay. Interesting. So is there just with all that, let's go down a couple rabbit holes here. First, the segmentation, the cost segmentation. How do you figure that out? I imagine you have to pay somebody to come in there and say, this is
Yeah.
5 years, this is 10 years, whatever.
Yeah, absolutely. So typically these cost segregation studies, they're done one of two ways. Typically, the first way is you would have an engineer who is well versed in this area. They would come down and they would survey your property. Think about it almost like an inspection, right? They're coming down, they're surveying the property, they're taking inventory of every component, and they're going to go back to their office and they're going to give you a report. That report's going to say, okay, well, your property has it's going to give you like an itemized report. Okay, this amount of property is going to be 27.5 year property. This amount's going to be 15 year. This amount's going to be 5 year. And that 5 and 15 years was eligible for bonus depreciation. So they're going to give you that report. And that's how it's done. Now, on smaller properties, usually properties less than a million, it's possible to do what they call a desktop study or a software cost segregation study, where effectively you fill out a form or you give the company information and they have their national database and their algorithms and their proprietary systems to figure out what a cost segregation study would look like for your property without somebody physically going there. So yeah, the bottom line is you're typically going to work with a company who's either going to come down to your property and do it in person, or they're going to do it virtually, if you will, and they're going to give you a report, telling you what the breakdown of what each type of property is for you.
That is so interesting. And then the IRS, do they come in there with the flag, or are they like, however you did the study, that's cool with us, or how does that work?
So the cost segregation study is actually how the property should in reality be depreciated. It
Oh,
should be but the thing is, it's so customary for people to just depreciate the entire thing over 27 and a half or 39 years that it doesn't matter. But technically, it's like the correct way to do it. Now, the IRS is not going to come after you for not doing it typically.
Oh,
But
because they're making more money that way,
yeah,
right?
yeah, yeah. They're not going to come after you for not doing it. But it's the cost segregation that's 100%, 100% like legitimate strategy. The IRS has an entire audit techniques guide on how it's supposed to be audited, to make sure that that stands up. But most of these companies that do them, I can't speak for everyone, but most of them, they know what they're doing. They have the IRS guidelines. They have their systems dialed in. They know what stuff costs. So you don't I've seen it happen before, but you don't typically see many audits around cost segregation studies, at least in my experience.
Okay. And just is there a guideline or hard and fast rule one for what a study would cost to make sure that it's actually you're coming out in the end better?
Yeah, it definitely depends on the property, the location, and the company you're working with. I would say you're probably looking at $2,000 to $3,000 minimum on larger properties. But on smaller properties, when you're doing that desktop or that cost segregation study, it could cost anywhere from 600 to $1,500 to do one, depending if you get audit support and the size of your property. But yeah, so it's most cases on properties that are above $500,000, it's it's going to come out to be cost. There's going to be a cost benefit there.
Gotcha. Awesome. Um, I want to dig in this a little more because it's so interesting to me. Because I just found out about this. And it's one of those things where I had a commercial property before and I learned about this after the fact. So I was thinking, wait a second, does that mean like, well, one, can you amend your previous returns and go back and say, hey, funny story. We just
Yeah.
did the depreciation over whatever, 30 years, 29 years, whatever it is. And we should have done this cost segregation thing. So can you go back?
It,
Or is it one of those things where you can, but you shouldn't? Or what's the
it,
advice there?
yeah, it is possible to go back and do it if it was like a year ago or so. If it's longer than that, typically what you're looking at doing is what they call a change in accounting method, which involves filing a form called 3115, and doing what they call a 481A adjustment, which is just accounting speak for what you're doing is saying, hey, I incorrectly reported this in this year, in this past year. So I'm going to do the cost segregation study. I'm going to bring the losses that I should have took in that first year into this year, right? So with this method, you're not necessarily going back and taking them back then on your tax return. You're just bringing what you should have done up to the current year in which you do this.
All right. And some of that could be substantial if we're talking 100% a couple of years ago, then 80%.
Yeah,
So
I
it's
mean,
not terrible, right?
I know we see this happen all the time. People, forget about it, weren't aware of it. Sometimes there's even strategic reasons to postpone it. Like for
Oh,
example, sometimes so what happens is like when you do these cost seg studies, you generate these large losses, and there might be reasons to not generate that large loss in that specific year you buy that property, but you may have more income, for example, in a future year, and you're aware of that, or it's coming, or it might happen. So you postpone that and you go back and you do this kind of corrective method intentionally to bring those losses into the future year when they will be more beneficial for you.
oh, got it. That is cool. It's interesting because I guess I was chatting with John Casman before, who introduced me to you. And I was joking with him a little bit about how the accountant that I have had, and the accountants of a lot of business owners that I know, when I'll chat with them and say, hey, I feel like I'm just giving my accountant the numbers for the businesses, and he's just throwing them in a program and saying, hey, this is what you owe for tax. And I don't feel like there's a whole lot of strategy involved.
Yeah.
It's just churning the numbers. But I feel like this is strategy that smart people know, but apparently I wasn't in that group or didn't get the memo on that.
Well, I don't think that's your fault. There's a lot of CPA, most CPAs out there, I'd say the majority, are tax preparers. And what their job is, they take your, like you just mentioned, they take your information, they put it in the tax return. They say you either owe the IRS money or you are going to get a refund. Congratulations. We'll see you next year. And they don't actually ever look at your tax situation, say, hey, well, hey James, if you did X, Y, Z, did you know that you could save, $10,000 in taxes every year? They never do that. And that's partially because they're so busy doing tax returns all the time that they don't ever have time to step up and breathe. But another part of it is that many accountants tend to be introverts. And there's nothing anything wrong with introverts, but I've certainly worked with accountants who would prefer to sit behind their computer in a dark room and just do the tax returns and not have to talk to anybody. And because of that, they never actually give strategic advice. So it's not only is it a timing issue for some people, for many accountants, but it's also like a personality slash skill set thing that they just many accountants just don't provide the service. So really, you have to be working with a tax strategist who's going to give you that, like, here's what you can do to reduce your taxes. And then what happens is when you go and you follow the advice of a tax strategist, you're going to make the moves throughout the year, or throughout the years, in some cases years ahead, so that when it does come time to file that tax return, when you do give that information to your tax preparer, your outcome is coming out more favorable to you. Because again, the tax preparers in many cases won't tell you what you have to do. They'll just tell you what you owe, what you don't owe.
Gotcha. So how do you find a tax strategist?
Yeah, so that's a great question. So depends on the industry that you're in, of course. In real estate, there's a handful of tax strategies out there. Our firm is one of the bigger ones. We do tax strategy for investors. So I would say there's two things you could do, or three things. I would say first start with your network. If you have a network of people, chances are you have other real estate investors, perhaps, or whatever industry you're in, and say, hey, do you know any tax strategists? Do you know any CPAs who provide this service? That'd be the first place I would start, because usually that's I found in my own personal experience when I hire people or look for services, getting a recommendation often comes in the strongest. Not always, but often. And then the next thing I would do is say go to Google. Just Google tax strategists for real estate or for whatever industry you're in, and see what they have out there. And I would, when you're vetting the CPAs, I would look at what content they're putting out there. And do they have demonstrable content that kind of shows you that they know what they're talking about, that they actually do the tax strategy. And that could be in the form of podcasts, that could be in the form of white papers, that could be in the form of videos, like YouTube videos, for example, could be in the form of webinars or live conferences or virtual events, things of that nature. So you just want to go out there. Those are the two ways I'd probably look at it. The third one is going to be go on the listen to podcasts. That's kind of built into the second one, I guess.
Sure. So just to clarify though, these are going to be people that have CPA in their title, they're accountants, but you got to dig deeper because there's no nomenclature, a bunch of letters that say tax strategist
Right.
versus just the number enterer guy.
Right, right. I mean, they might have titles like not they might have titles like tax strategist or tax advisor. Those are typically the titles you want to look for when you're looking for this type of advice. And now, having said that, there could just be there could be advisors who are just going by the name tax professional or tax or senior tax advisor. It's gonna be like senior tax accountant or something like that. But usually the advisors are gonna differentiate themselves by calling themselves a tax advisor or tax strategist to let you know, or tax planner, to let you know that that this is the service that they're providing.
Gotcha. I want to dig in this a little deeper because I imagine there's a lot of business owners that want to know. I know I'm certainly one of them. Now the tax code is whatever millions of pages, and no one person could possibly know all of it.
Right.
So is it better to find a tax strategist or advisor, someone in your vertical, whether that's real estate or I don't know, hair salon, I don't know, whatever your business is, if they
Yeah.
exist, or how do you figure that out?
Yeah, I would say whatever your primary business is, whatever your core business is, go try to find a tax strategist who specializes in that, because that's most likely where you're going to have the most impact is in your core business. Like for example, at our firm, we specialize in real estate, so all of our clients are real estate investors. Now, some of them have other businesses. Sometimes they might have a medical practice, they might have an e-commerce business, they might have an IT company, they might have these businesses that are kind of like ancillary to their business, but it's not the core, if that makes sense.
I want to dig into the real estate syndication a little bit deeper. One step I forgot to ask you: if I'm an investor or I got a small business is bringing in a nut, something like that, and I need somewhere to put the cash, that doesn't necessarily need to be crazy liquid. Is it, or let's just talk about a minimum dollar amount that you would typically see in syndications? Because I imagine they're not just taking quarters and dimes or $5 here. It's got to
Yeah,
be, there's got to be a comma in that number somewhere, I imagine.
yeah. So
So
so most
where, yeah,
sorry.
go ahead. Where is that number typically at?
Yeah, so most syndicates and funds, you're probably looking at $50,000 as the minimum. There are some that will like have that are either just starting or perhaps they want to get new investors in, so they'll have a lower amount of 25,000. So you're usually looking at between 25 to $50,000 minimum. I'd say 50,000 is becoming more of the common number that I've been seeing, but there's certainly ones out there for 25,000. Now, that's if you're investing. Now, there's something called crowdfunding. There's these crowdfunding websites out there that where you can actually put less in, like fractional amounts, like $1,000 into some syndicates,
Oh, wow.
which is I've never participated in any of those. But they do exist. But for typical syndicates and funds, it's 25 to like 50,000 minimum.
Okay. Gotcha. And then as far as vetting these sponsors, what you call it?
Yeah, sponsors
Just
or
weird
syndicators.
nomenclature.
Yeah.
Sponsor, I always think of advertising, but turn into money either way. So to find a sponsor, I imagine there's quite a few of these around there,
Yeah.
but you have to find someone that one is not going to run away with your money, but two, I imagine it goes deeper that they know how to find the properties. They have property managers that can take care of them and all the things that go in there. I suppose the headache that you're trying to avoid.
Mhm.
How do you figure that out?
Yeah, so that's a great question. So there the first way to figure out the way I found out about a lot of these sponsors was a podcast. Like if you listen to a podcast like John's, like John Kasman's, he's going to have a bunch of sponsors, I'm sure, on the show talking about either their business and what they do and how they evaluate properties and all that. So listening to podcasts is one way. Going to conferences, going to real estate conferences like the Bigger Pockets conference is one out there that you can meet sponsors at. There's also online communities. I'm part of one of them. It's called Left Field Investors. I'm not affiliated with them in any other way aside from the fact that I'm a member. But what this community does is they have sponsors that they vet. It's a community that vets sponsors collectively. So they might say, okay, hey, I invested with so and so, and here's my experience. And if you go onto the forum, you'll see dozens of these posts with dozens of sponsors. So that's one way to find out. I would say, yeah, that's probably joining a community is probably the best way to do it because you're kind of getting pre-vetted sponsors a little bit. You still should do your own due diligence, but you're going to have a lot of pre-vetting going on, and also you're going to have a lot of access to what's out there. However, then also getting on podcasts and listening to podcasts by multifamily investors or commercial investors. That's also how you'll be able to find about them. There's another podcast called the Syndication Show. It's a daily show. At least last I checked, it was a daily show, and what they do is they basically interview sponsors all the time. So if you listen to that show, I'm sure you'll find out about a lot of sponsors really quickly. There's also another one called The Best Ever Show with Joe Fairless, and that's another show where there's plenty of sponsors who've been on that show. And yeah, so listening to podcasts, going to conferences, and joining communities or networking is probably the best way to find these things.
That the best ever show. That's got to be I'm going to dare say the second best name of a podcast.
Yeah.
Maybe even one up on us. Authentic Business Adventures. That's an incredible
Yeah.
name.
It is. It is. It is. It is definitely. There's a battle right there for it.
Dang. And it's a real estate thing.
Yeah. So the best ever. It's called the Best Ever Real Estate Investing Podcast, specifically, if I'm not mistaken. But I know it is the best ever. But yeah. So that podcast is another good podcast to check out for that.
Gotcha. Now let's dig into your life a little bit here. Are you a CPA by day and then real estate investor by night, or by? I guess you really don't have to stick a whole lot of anything in there time wise.
Yeah.
Like, tell me about your life and your investment strategy. What's worked for you?
Yeah, so I'm a CPA full time. So this is my primary occupation. I've been investing. So when I like a few years ago when I did that 18 unit apartment community, that was on the active side. Around that same time we closed on that deal, the purchase side of it. This is when I started here with this firm. So that was a part-time endeavor. Most of the legwork was done. We only had to be on a few calls a week for property management, and one of my partners would go down and check out the property. So it was a light lift for me. Then COVID happened. We ended up selling that property during COVID, and we had it under contract to sell in March of 2020. Everything was going well with the sale, right? Everything was going well with things smooth sailing. Then COVID hit, and they executed their extension to April and then forced us to May, and we ultimately sold the property. My plan was, I say that because my plan was to go do this again, right, on a part-time basis with partners. Because when you're doing it with partners, it's easier to do, or less time. There's less time commitment because each person plays their role. But then I started just investing on the limited partnership side. So I just started investing as a passive investor, just with other sponsors or other syndicators, and and that's what I was doing up until this year actually. And one of the sponsors that I was investing with, I had a long-standing relationship with some of their founders, and I said, "Hey, look, you need assistance on the marketing side of things. I know how to do marketing. Let me help you with investor relations." So I ended up teaming up with them. So now I'm on the sponsorship side with them. They're Dual City Investments, and we have a fund, and so I'm my role there is to help investor relations, so generate leads, investor leads, as well as build our investor relations process and systems out, so that we can so we can take advantage of the opportunities that are coming our way. Because Dual City, the partners there, they're Keith, one of the founders, and Mike, they're phenomenal operators. But where the gap is the digital marketing side, right? So, and that's kind of where I come in. So that's more of a part-time endeavor for me at this point. I'm doing it part-time, nights and weekends type of thing, and that's kind of how it fits into my lifestyle. But I'm predominantly day job as a CPA.
Gotcha. That is so cool. That's impressive. It was always interesting to hear what people that are essentially in the money business, right? Whether it's accounting, financial planning, retirement, all that kind of stuff. What are they investing in?
Yeah,
Because a lot of times I'll end up meeting people in the, let's just say, financial services, right? Somebody trying to hustle mutual funds or stocks or whatever it is that they're selling.
yeah,
And I look at their lifestyle and what they're investing in. And I think if you were really making as much money as you're promising me, I don't know that you'd be talking to me right now.
yeah.
Just
You know,
an interesting dynamic.
Yeah, no, it's definitely interesting. There's definitely different philosophies out there. I've seen financial planners and accountants invest in all types of things. For me, I tend to invest in real estate predominantly because it's tax advantage. Because I'm getting tax. I get taxed as ordinary income on the income I'm getting from the accounting firm, and then the syndicates and funds help kind of shelter that income from tax, making it tax efficient. Having said that, though, I'm not a real estate purist. I do have holdings in like in index funds or ETFs as they're called, or also known as, I guess. Um, and so I'm not a real estate purist. I do have holdings in stocks, and I do kind of do both of those things. So
Sure, little diversity never hurt. It's all good.
right.
I do want to dig into one thing, one other thing. I know we don't have a ton of time, but I want to ask you about the contract that if I'm throwing money at one of these real estate things, I imagine there's contracts with all kinds of provisions and stuff like that. Are there any things that I should look for specifically, or things that if I do see them, I should run away and find somebody else?
Yeah, so these contracts that you might be signing when you enter in a syndication, they're going to give you what's called a private placement memorandum, or a PPM. And that PPM is going to tell you that basically, I'm gonna, this is a joke here, but I'm gonna tell you that you can lose everything, your shirt, your kids, they'll come and take everything you own. Now, basically what it's saying is you can lose all your money in these investments. That's what their PPM is going to say, and that's to protect the sponsor in the event that that does occur. Now, that often doesn't happen, but that's what you'll see on the documents. So I can't say you would want to run from that. What I would say is that if you have sponsors that you say go on a forum or you hear through different parties, that they're consistently lagging their own performance, because like what happens is sponsors, they'll project they the future's not perfect, but they'll project what the returns will be, when you'll get distributions, kind of the timeline of the deal. Now, if they're constantly underperforming, if there's constant issues with these sponsors, that's when you want to run, right? Or if uh, yeah, that's when you want to probably avoid them, is when you hear constant issues, they're constantly missing projections, they're not transparent in their communication. Like, investor communication is crucial, because as a sponsor, you're taking someone's money, and now you have to be a steward of their capital. And if they don't hear from you ever, right, you're not sending out your quarterly emails, someone emails you a question and you're not getting back to them, that's a major red flag. So transparency, and timely communication helps build trust. So if you hear that people are not timely on communication, they never answer. Okay, here's a good way to do it. Here's what some partners will do. They'll go and they'll vet a sponsor, and they'll start answering the sponsor. Excuse me. Asking the sponsor questions, and they'll see how the sponsor reacts to those questions. Are they getting annoyed? Are they getting frustrated? Are they timely in their communication? And if they're getting annoyed, frustrated, or not timely, then that could be a red flag. And sometimes what someone told me they'll do is they'll go as far as to get all the answers to their question that they need. Then they'll ask one more question just to see how the sponsor reacts.
Oh,
Just to test, like,
interesting.
kind of just to test, like, is this if because they want to know, they're not trying to be a pain necessarily. They're just trying to see, okay, like, how professional are you? How timely are you? How well do you know your stuff? Are you going to treat? Do you respect me as an investor, or am I just another number of the hundreds of investors that someone might have? So I would say if they're not timely in their communication, if they're not patient with you, if they're not within reason, of course, and if they're not answering your questions timely, I'd say that could be a red flag too.
Interesting. I love it. This is great information, Thomas. Tell me, you have a website. Can you share that website with the crew?
Yeah, so the website for the accounting firm is www.therealestatecpa.com. So that's our accounting firm website. Dual City's website's dualcityinvestments.com. So those are the two websites.
Gotcha. Dual City. Remind me what that is.
So Dual City Investments, we have we're basically a sponsor of a fund, and we have properties, commercial and retail property, excuse me, commercial, residential, and retail properties in the fund, and we're chugging along here, so it's fun.
All right. You, I know we don't have a ton of time, but I do want to ask you about this. Residential versus commercial. Commercial, I've heard people are just getting beat up. I don't know what your experience has been. Can you just touch on that a little bit?
Yeah, so it definitely depends on the type of commercial. Office and retail have not fared as well over the last number of years, especially office has been getting beat up a lot. However, there's been a lot of excitement and a lot of positive momentum with industrial. Uh,
Mm.
because in industrial, there's a lot of like Amazon centers, and there's a lot of need for warehousing and things like that, manufacturing. So that has been doing better and has positive outlook. Residential has also seen multifamily has also seen some turbulence due to the rapid rise in interest rates. That's kind of true across all asset classes, but multifamily has been a lot of syndicators who got themselves in trouble because what they did is they took floating rate debt, or bridge loans, they call it, which basically says you're going to have this interest rate for 2 years. All right. And we're going to go and at the end of 2 years, you're going to have to refinance the property. And what happened was the people who took the loans at these lower interest rates in the prior years, thanks to this rapid rise in interest rates, now the interest rate's so high they can't afford the property anymore. The property
Oh,
can support the debt that they have to refinance. So that has seen some turbulence, but fundamentally, there's so much demand for housing that the supply is just in the long run is just not going to keep up. So in the long run, residential still has a good runway due to just the fundamental supply and demand factors, and same thing with the industrial. But office is definitely struggling right now.
gotcha. And if you had to predict as far as interest rates go and all that jazz, would you say we're stuck in 2024 where they're at, or stuck? I guess depends on your position where you're at. If you're putting money away, if you're trying to invest it.
Yeah, I would say like, I don't have a crystal ball. I think it's a disclaimer
No,
after,
no one
but
does.
but I would say I would be cautiously optimistic that they would decrease interest rates slightly before this end of this year. However, just looking at the track record of what the Fed's projected, they were originally projecting multiple rate cuts already that they already postponed. And so they're going to be taking in the inflation data, and they're going to be making assessments, or I guess judgments based on that, on what they're going to do. So I want to say I want to say that it's possible if they reduce interest rates this year, but it's anybody's guess at this point what's actually going to happen.
Fair, fair. Yeah, I wasn't expecting to be like, this is how it's going to be, right?
Yeah.
Everybody knows, but no, no one knows. But it is interesting to hear when you're in it on the CPA side and you're also in it on the real estate side. I feel like you have your ear to the ground at least a little bit more than many people,
Yeah,
arguably most people.
yeah. I mean, I would say it could happen. I would not be surprised to see interest rates fall a little bit this year, but I would also not be surprised at the same time if it didn't, just because of what's going on. So I'm cautiously optimistic that it will drop.
Fair. I get it. Well, Thomas, thank you so much for being on the show.
Thanks for having me, James. It was an awesome time today.
Yeah. Can you tell us those websites one more time?
Yeah, so our CPA firm's website's www.therealestatecpa.com and our fund, dualcityinvestments.com.
Awesome. I love it. This has been Authentic Business Adventures, the business program that brings you the struggle stories and triumphant successes of business owners across the land. My name is James Kademan, and Authentic Business Adventures is brought to you by Calls on Call, offering call answering and receptionist services for service businesses across the country, on the web at callsoncall.com. And of course, the Bold Business Book, a book for the entrepreneur in all of us, available wherever fine books are sold. If you're listening or watching this on the web, if you could do us a huge favor, give it the big old thumbs up, subscribe, and of course, share it with your entrepreneurial friends and those friends that may need a little place to invest a little bit of cash so they can get that money to work for them. We'd like to thank you, our wonderful listeners, as well as our guest, Thomas Castelli of Hall CPA. Thomas, thank you so much for being on the show.
Thanks again for having me. It's a pleasure today.
Yeah. Past episodes can be found morning, noon, and night at the podcast link found at drawincustomers.com. Thank you for joining us. We will see you next week. I want you to stay awesome. And if you do nothing else, enjoy your business.